Today, it's the great property Paperchase. Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news, another Friday. And Tarric is back with me again. Hi, Tarric.
Hello, Martin. How are you, mate?
I'm pretty good. Though I have to say that the volume of data and the indicators sort of pointing from the data suggest to me that things are not necessarily that comfortable at the moment. How about you?
Yeah, I'm not too bad, mate. Yes, there is certainly a lot going on, isn't there? I mean, you've got, the geopolitical developments in the Middle East, and then you've got everything that's going on in markets. You've got, short-term US yields hitting the highest level since the dot-com bubble. And then on the other hand, you've got, other data releases, say, for example, coming out of the UK where you are today, of very, very bad retail sales.
Yeah. Well, let's just quickly go through the headlines, right? So bond yields now are sitting around 5%. And what's interesting, it's pretty much across the curve. Now, that to me is an indication of significant uncertainty. Almost always the yield curve goes flat when people don't know what's going on. Although there are some people arguing that, in fact, the whole bond yield curve has got unanchored, or indeed it's a reaction to the political turmoil around the world, and particularly in the US, and of course the need to print ever more money in the US. Now, all of those factors are probably there, but the consequences of this are really significant, and there are two which I want to highlight. One is that mortgage rates for 30 years in the US are now 8%. That's a huge number. 8% for 30 years if you want to go buy a property with a 30-year mortgage in the US. The second is that, of course, as yields have gone up, bond prices have dropped. And in the recent results over the last week or so, it's interesting that some banks are now talking about marked to market losses in their bond portfolios. And the question, of course, is, as this higher for longer thing goes on, how much longer can you sit on those losses, right, and not crystallize them? And of course, even central banks have massive losses which they haven't crystallized because, of course, they were holding huge bond portfolios. So there's a really interesting question as to how much of a hollowing out of balance sheets is really going on, and if and when any of that will actually be manifest.
It's really an interesting one, isn't it? Because I think that in some ways that this is all sort of illustrated nicely by the Bank of Japan, because they are the ones out of all the central banks who are the most stuck. They are the nation that has the most debt, and they are also the nation that can for that reason afford rates to go up the least. But they've also got on the other hand, they're trying to balance the strength of their currency against that and not have their currency depreciate. And I think that they are really sort of like, in some ways, the key to this, because when the Bank of Japan said we are raising our yield target on the yield cap, I should say, on their 10-year bond from 0.5% to 1%, that was part of the catalyst for the yields taking off more broadly. And Japanese yields are still rising. They've gone from 0.5% up to 0.85%. So there's still a little bit of a ways to go there. But I feel like that they're trapped. There's nothing that they can do. And I feel like that is just where it is across the board. But I think that Japan is really just emblematic in some ways of the hard decisions that have to be made or not made, in the sense that they're just sort of hoping and hoping and hoping that there's a crisis or something breaks or there's a recession to get them out of jail and save them. And I kind of get the feeling that there's a little bit of that going on down here in Australia, with the RBA just hoping that, we don't have higher for longer, because I don't really think it's something that many central banks, if any, have really prepared for.
Well, could I be provocative and say that a war might be quite convenient, insofar that it actually gives a bit of an alibi?
It could. I mean, what do they say in politics? It might have been from Yes Minister: never let a good crisis go to waste. But I think that it would provide with a degree of support to their narrative, in the sense that we're reaching a point now where it's very difficult to still blame things like supply chain issues and all the other various things, or government stimulus or whatever. We have reached a point now where it's very increasingly difficult to just say, oh, it was this, oh, it was that, yeah. Oh, it was the war, it was this and that. The war in Ukraine, started now, almost 2 years ago now. But so they're running out of excuses. So it would give them another excuse. And I do wonder to what degree Bullock and the RBA are just bluffing a little bit, shall we say, just in the sense that they know that if they aren't hawkish enough, the Australian dollar is going to fall down a flight of stairs, or perhaps even an elevator shaft, depending on how the market responds. But if Bullock is hawkish and does, sort of push that bond curve up a bit, and gets the market to price in a little bit more upward action in the cash rate, that helps insulate the dollar. So it's going to be very, very interesting to see what the Q3 inflation figures look like.
Yeah, and just a couple of other interesting observations. Of course, this last week, the Fed speak was up to 11. We had day after day, we had more and more Fed officials coming out, and they were sort of spraying comments all over the place, but tended to probably bias towards being a little more gentle on where rates may need to go, although they were still saying rates will be higher for longer, not necessarily going higher. But then Powell came out yesterday and really, again, said, no, we're probably, in a situation where rates may have to go higher, and they will be higher for longer. So once again, I get the feeling that in the US, the Fed is a bit all over the place, and different Fed members are on quite different playing fields. Well, whether that's deliberate or whether that actually just represents the range of views. But I did note in the minutes in the US there was some variation in terms of what people were thinking and expecting. And of course, the other point is retail sales. You mentioned it in the UK. Retail sales, inflation adjusted, continue to go backwards dramatically. Non-discretionary spending, of course, is where people are having to spend more of their money, so discretionary spending is going through the floor. But if you look at the US retail sales, they have the same characteristics. So whilst the top line number wasn't too bad, it was a bit stronger than people expected. On an inflation adjusted basis, it's still going backwards. So even there, I think the whole mythology of the consumers doing great, they're still spending strong, is a bit of question mark. I would argue that the Australian situation is already, showing those same stresses and strains. And of course, if the consumer does fall over, and with higher interest rates, you might expect that to happen, that's going to put another significant pressure on the economy. But inflation is still not dead.
No, and I think that the retail sales one is an interesting one in the US because we are down from the peak. The peak was all the way back I'm talking about in inflation adjusted terms. The peak was all the way back in March and April of 2021. But one thing that has interested me recently, and I was just looking at the data the other day, is that in inflation adjusted terms, they've actually been rising from their lows of where they were back in April. So I think that there is, sort of some degree of improvement there in the US economy. Now, for what reason, I don't know, but I have a feeling that it's more likely the spending of the affluent and perhaps even a little bit of the wealth effect, even though people on the bottom end of the pile in the US, people who are suffering more from inflation, people on lower incomes, are struggling, perhaps worse than they have in a long time.
Yeah, I think that's probably right. And again, averages mask a lot. And it's true in Australia too. In my surveys, I see the same. There are still some people who are relatively insulated from all of the pressures. They don't have a big mortgage. They've still got quite a lot of savings buffers. They're still spending freely. There are others who are not. And by the way, those who are actually trying to save for a mortgage, right? They're putting a bit more money away now because they're getting more on their savings. But on the other hand, the price moves in Australia are such that they're still sort of getting further away. I did a show earlier in the week suggesting that the drawbridge was being pulled up, and effectively it was harder and harder for new people to get in. I noticed this week a lot of your charts are around housing. So why don't we do a deep dive on housing and sort of use that as a bit of a microcosm to understand what's going on?
Yeah, sounds good. So we'll get started with the charts. As usual, the charts are available at avidcom.substack.com. I just want to take a moment to say thank you to those who have subscribed to my Substack and to my Patreon, largely as a result of my appearances on DFA, and I thank you very much for those messages. They are very much appreciated. and it just helps this be a little bit more financially viable with me putting, so much time into all the various things I do, including DFO. But we'll just get into the deep dive on housing. And here we have a visual representation of the Australian economy. And those pillars holding it up are the mining sector and housing prices. So we'll get right into it.
I love it.
Now, I quite this is a chart from Shane Oliver over at AMP, and I quite like it because it shows how long it takes to say for a 20% deposit. Now, this is based on the median household income, the national house price, and the household in question saving 15% of their gross income. Now, one of the reasons I like this chart is because it's based on household income. Now, one of the criticisms that you get a lot of various price to income ratio charts, especially ones that go back this far, are, it's based on single income. What about the rise of women in the workforce? What about female participation? And admittedly, those are significant drivers of additional household income. However, this chart accounts for that. And I think it really does tell the tale of just how much more expensive Australian housing has become relative to incomes over time. And, to use your drawbridge analogy, Martin, just, how much bigger that gap has become over time.
Yeah, and it's interesting because in my data, if you go back, a decade or two, the average first-time buyer was age 24, 25. Now the average first-time buyer is in their 30s, and it's still rising, the latest data just out of the surveys. So people are delaying that initial purchase because, of course, it takes so much longer to save. Which, of course, also means that at the other end of working life, you've got a mortgage still as you move into retirement. And so the other knock-on effect of this is that actually, as you move down the generations, as it were, you're going to see more people with bigger mortgages for longer, not least, of course, because the average mortgage term is also now, 35 years rather than 25. So that's also another factor in this too. And it goes back to this fundamental point that the economic drivers of housing versus income are just shot.
They are, and I think that you make a good point. I mean, there was an article in The Conversation, and this was a long time ago now, but this was based on data, I believe, from about 2014, 2015. And that was showing a sizable proportion of people retiring with mortgages. Now, those mortgages, if you sort of imagine that they were written 20 or 25 years ago, you're talking about mortgages from the mid-1990s or even the late 1980s. And in relative terms, even if you just look at this chart, housing was, relatively speaking, far more affordable then. When you start seeing the people beginning to retire who had mortgages written in the mid to late 2000s, that's going to become quite a bit more challenging, and you're going to see quite a lot more people retiring with debt. And just on the first home buyer thing, I think it's interesting because they get told you got to get your foot on the ladder, buy whatever. But as you said, the age of the median first home buyer, especially in markets like Sydney and Melbourne, is now in some ways on the wrong side of 35. So these people, if they are going to have families, a lot of them already do. So you can't just go, if you've got a kid or two kids or three kids, you can't just go and buy an apartment. A lot of 3-bedroom apartments are just as expensive as 3-bedroom houses. So that has added another challenging dimension to the housing price question.
Yeah, absolutely. And one other point about this chart, of course, this is an average, as you said, it's the average across the country, etc., etc. That now, if you were to actually overlay specifics like Sydney, for example, the average duration to save in Sydney is a lot longer. In fact, looking at some of the calculations that I did recently, it was 15 to 16 years. So if you are looking to buy something, as you say, for longer term occupation rather than just the smallest shoebox you can find just to get on the ladder, it's a whole different proposition. And the other factor, of course, in all of this is that you're also now competing with migrants coming in, some of whom have significant capital behind them already. So there's another reason why it is that property prices are going stupid. But for the person or family trying to get into the property market, it's never been harder.
Indeed, and just a point of clarification on the chart. This is based on property prices at the time the snapshot was taken, not including the price growth that occurred afterwards. So, for example, if you were to take a family on a median household income in Sydney and see how long it would take for them to save a deposit on, say, a median priced Sydney house. Now, going by, say, Domain's numbers, that's a house that's worth about 1.3 or 1.4 million. Now, based on long-term housing price growth, that would, and you factor that into the calculation that the deposit hurdle continues to rise rather than remain static, that ends up being infinity years. It's not possible. With even if you add in, say, like, 2% interest on the growth of the deposit, it's just not possible. There either needs to be investments, or there needs to be some form of below trend housing price growth.
Absolutely. And of course, the other factor, just in terms of the longevity of mortgages, as we said, typically mortgages are longer now when you start off. But the other thing that's happened over the last 20 years or so is that more people are drawing more equity out through their life. So one of the other reasons why we've got people at the other end of the spectrum moving into retirement with mortgages is because they've raided the equity in their property on the way through. And equity, mate, has been a very, very big component in the housing story.
It has, and I think it's just worth noting that if the latest data for broader household personal income is, unfortunately, it's 3 years old. It's from 2020, but at that time, personal income from employment, owning a business, or superannuation was $983 billion a year. Now, in the 2020-2021 financial year, home equity withdrawals were $93 billion. So you're talking about almost a 10% boost on top of these main income sources for households, and that is a fairly significant move up right there. You're talking about something like 4.5% of GDP, and we sort of blast the Americans for their irresponsibility in using homes as ATMs, but their home equity withdrawals to GDP peaked at a little over half that.
Absolutely. And of course, the winners are the banks, because they have more people paying more interest for longer, and particularly as interest rates rise as well. And the average loan is a lot bigger than it used to be because the average property price is bigger. And, everyone's now been, quote, educated, unquote, to be able to use that equity as they're on the way through. It's a mess. I use the term Paperchase in the title because one of the points I want to make is there's a lot of stuff being written about housing, a lot of information, quote unquote, that's being actually thrown around the place. But a lot of it is nonsense, because when you actually start stripping back what's really going on and you start looking at some of these underlying charts, you realize that it's a huge mess. And it's just worth reflecting. In your earlier chart you showed this building on the skew, right? And as you say, the supports were mining and housing, and housing has become such a large and critical element in the Australian economy that it's almost impossible to deal with it in a way that makes any sense at all. And so we're relying on this sort of edifice sort of not falling over much further. But of course, with higher interest rates and with real incomes not growing at all in inflation-adjusted terms for the last decade, it's going to create massive issues.
Indeed, and just a little side note here. All these charts are available on my Substack, but there's also an article that Martin will put down in the pinned comments on housing and how it powers the economy, and it goes into all this in greater detail. So if you want to have a read of that would be greatly appreciated. Share it with your friends and like-minded people, and I'll get on to the next chart. Now, this is one of the issues with comparing housing markets is one of the metrics that people use is value of housing stock, the ratio of that to GDP. Now, that's a bit of an issue here in Australia because a lot of our GDP is driven by the resources sector, and that distorts things fairly heavily. So what I've done here is I've instead done the ratio, which is the value of housing stock to gross household disposable income, which is household income minus taxes and transfers. And as you can see that over time, that ratio has continued to decline as rates have fallen and property prices have continued to rise. So I think it just goes to show that, that things haven't always been this way, even not that long ago in the grand scheme of things.
Yeah, that's very interesting. And just to clarify, that is after taxes. So, of course, households are paying a greater share of their income in taxes than almost ever before at the moment, because of the fact that the tax bands have not actually been adjusted for a long time and probably won't be into the future. So what it tells you is that the value of property is still, relatively high. I guess the question is, where is this trend going to go to now, given the fact that we've now got the pressure on incomes? And I guess the point about gross disposable income, that includes money that you might want to be spending on things like food and other necessities. So another way of thinking about that would be not gross disposable, but actually, net after normal stuff. And I think if you did that, you'd find that the rocket was going even higher.
Well, I think that's the thing. If you're talking about the median, it gets rather messy and rather dark and unpleasant relatively quickly. I mean, this is obviously an aggregate measure across the entire economy, across all households put together. So, you take the billionaire class and the top 1% out. I imagine that this would look quite a bit different. But yeah, I think that it just goes to show that this is an ongoing thing, and it's something that has to sort of continue to happen. It's like one of those, I forget what they're called. The domino effect, where it just it needs something to keep going and going and going. What is it? The Goldberg machine. Where so you knock something over and then it just creates this entire hilarious chain of events. And I feel like with the Australian housing market, you need that ongoing thing, and there needs to be something boosting it constantly to keep it going and going and going and going. And the question is, where does that end? And honestly, I don't know. I mean, I took Albo at face value last year and I took him at face value, prior to the election, when he said, I do not support the Morrison government increasing the permanent migration intake to 160,000. And I think that we need to reform temporary visas and that this whole thing is broken. And then did the complete opposite of that.
Well, of course, migration is now as high as it's ever been and continuing to go higher. The long-term estimate was another 14 million Australians coming into the country in the next 40 years, according to the long-term plans. We're ahead of that already based on where it is currently. And just to sort of put that in context, that means we need another Sydney, Melbourne and, Perth built to accommodate them?
Yeah. Yeah, about that. Yeah. No, it's silly, and I think there's a lot of myths and a lot of politicizing, unfortunately, that goes on around this issue. I just want to have personally, I just want to have an issue. I just want to have a conversation about the numbers, about what's possible. But there is all these different indicators that show the stress that is occurring on the system now. It would be silly to say that this is all down to migration. No, there are many, many other factors, but that is one factor with a lever that we can pull right now. Even just returning to sort of pre-COVID levels of migration would be a substantial difference. It probably wouldn't change anything for the better, but it would stop. The sort of deterioration from continuing. I mean, realistically, considering the deficit that we have in housing, some people say 70,000 homes. Some people say 100,000, some people say 150,000. You multiply that by the number of by net overseas migration, you're talking about it probably a couple of years for the building sector to catch up and build enough homes. And then that raises the question of, did we build them in the right places for those people? So it's a complex picture.
Well, there was an interesting conference up in Brisbane, particularly on the housing and construction, and there was a very interesting discussion went on at one stage, which said pretty much this: we need more builders to build houses in Australia. So what we need to do is we need to actually import, through the migration program, more builders to build homes for the people that are coming in as migrants. And I'm thinking, hang on a moment, that's a bit recursive, isn't it? So basically, you increase the migration path and bring more people in to build the houses for the people that are actually just coming in because of the higher migration. The other point, of course, is that how sustainable is that? And, you only have to look around at the inability for building starts to get completed at the moment. There's a lot of half-built properties around the place, thanks to home builder and thanks to building failures and other things too. The building starts is quite low, but the number of work-in-progress projects is very high at the moment, and yet they're not able to actually finish them. So there's a really big question about whether you can actually build enough places for people to live, as well, of course, as the point you made in I think the previous show was you need to actually 35,000 new jobs each month to be able to actually keep the unemployment rate in a similar range to where it is. What was the number this last time around? Somewhat lower.
Yeah, well, that's because of all the revisions and the declining in the participation rate. Those revisions were big.
I know. Yeah, talk about rubbery numbers.
Yeah, they were. I tell you what. But we should probably go on to the next slide. Okay, now previously I showed the value of residential housing stock to gross household disposable income for Australia over time. Now this is comparing Australia with the US, UK, and Canada, and the outlier there is China because they have the biggest property bubble probably in the history of the entire world. And I just think it's interesting that we are a fair bit higher than even Canada, and their property bubble's pretty bad. And in terms of comparing us to America, even though the Americans keep talking about their property bubble, well, we're in a completely different galaxy by this metric.
Yep. Well, we hold, a number of prizes. Probably the prize for the biggest debt from a household perspective, according to most statistics I've seen, maybe after Switzerland, depending on how you measure it. But this chart here just really underscores what I've been saying. And you talk about bubble. I would say that a bubble is something which may be a little bit temporary and then goes away again. I would say this is a structural problem, right? This is a set of policies over a decade or two that have created this monster. So this is not just a happenstance, right? Things have been pulled in a particular direction. Levers have been pulled in a particular direction to get to this point. So this was actually a deliberate strategy rather than actually just a happenstance.
Yeah, I mean, I think the thing is that if you look back on Australia's growth, and it's in particular its growth drivers over the decades, you're talking about like manufacturing in the 80s, you're talking about, say for example, in the late 90s into the early 2000s, it was the huge expansion of household debt, which helped power the economy. But then you look sort of post 2008 and per capita growth falls away. Once the mining boom ends, you see basically household incomes stagnate while there's some upward movement. At the end of the day, today they're pretty much stagnated compared with where they were over a decade ago. And, that has been the time where we have pursued what I would just consider to be housing price-led growth. Now, there's some households, the ones who hold the assets, who've done very well out of this. But for the average household, perhaps better said, the median household, things are quite a bit more challenging, especially for households under 35 who are basically now sitting on, levels of real incomes and real consumption that have more in common with 2005, 2004, even though here we are almost 20 years later.
Yeah, and again, averages mask, right? So we know that there are some people who done very well, although it's a paper thing until you actually come to crystallize the value of the property. And so in many cases, the wealth effect is a little bit, illusory in some cases. But it is interesting, if you look in some areas, and I was looking at some of the investment properties that were purchased over the last 3 to 5 years, particularly like North Ryde, for example, in Sydney. There's been no real appreciation of value over that time at all. So what you discover is that this wealth effect is partial. In other words, there are some areas that have done really well, some areas not. Then, of course, you've got the other problem, which is that you've got older households with significant equity that they're sitting on at the moment, and now they're trying to work out what to do. So there are some people saying, oh, maybe I should sell and down trade and create that crystallization of the equity, the 300k or more, if you've got superannuation, that you can throw it into superannuation if you're over 55. So, for example, that's something that's going on at the moment. So you've got this really unequal struggle between different cohorts. But the people who are absolutely caught are the under 35s, because more and more of them are renting. And if you look at the recent data that showed the proportion of people by different cohorts who actually own property versus renting, in fact, there's been a significant drop in those younger cohorts over the last 20 years ago. And if you look overall, the proportion of people who own property overall has dropped, and the proportion of people who own property outright without a mortgage has dropped over the last 20 to 30 years. So on any metric that you want to, bring to the table, it's actually failed. So this whole set of strategies and initiatives have actually ended up with creating more debt, have been creating more pressure on more households to spend a greater proportion of their income on just somewhere to live. And like I said, the only winners that I can see are, one, the government, because of course they enjoy all the taxes, stamp duties, state and federal, plus of course the banks, who actually have expanded their balance sheets remarkably and are still lending like drunken sailors, and because of the fact that interest rates are higher now, they're actually getting bigger returns. And of course they were also supported by the term funding facility on the way through too. So how unequal is that?
Yeah, I mean that's part of the problem going forward, isn't it? You've got these people, you've got people at the bottom end who are in some cases just trapped. It's very difficult to save a large enough deposit. It's very difficult to afford, a desirable house, and I'm not even, or a desirable home. And, you're talking about some expectations that have been, fairly substantially shifted compared with where they were before. But something that's really interesting to me is recently Housing Australia, which used to be the National Housing Finance mob, released a report detailing the number of people who'd used the various first home guarantees. Now, of those, there was about a little over 30,000 in the last year. So you're talking about almost 1/3 of all first home buyer finance commitments being backed by the government. Now, if we put that together with your data regarding the Bank of Mum and Dad, which is that for the same period that Housing Australia did it in, which was the prior financial year, that averaged out to be about just a little under 30%.
Yep.
So you put all that together, you're talking about potentially 60%, assuming no overlap, 60% of the first home buyer market being supported by either ALBO or Mum and Dad. And then next year, they're also going to have the ALBO shared equity scheme. So, it's very, very quickly becoming the ALBO and Mum and Dad property market rather than something that people can do on their own.
Yeah, and by the way, in my data, there is an overlap. So there are some people who use the first home owner grant program plus getting money from the Bank of Mum and Dad as well. So it's not necessarily, mutually exclusive. But it's probably a weakness in the scheme, by the way, because I'm not sure that necessarily the due diligence that they do is necessarily totally appropriate. But, what it basically says is unless you can get help from the government, or unless you can get help from wealthy parents or grandparents or, other family members, you're stuffed. Yeah.
Yeah, I mean, it's not a pretty state of affairs. Okay. Now, this is of what proportion stamp duty is of overall tax revenue for the 5 largest states. Now, I will caution by saying this is a proportion of tax revenue, not overall revenue. So this doesn't include things like mining royalties or resources royalties, or it also doesn't include the grants from the GST. But the point is that it is a huge driver of overall revenue, of levers that the states themselves can actually pull, and that they are not reliant on either global commodity markets or the federal government for.
And, you stand back and think, so they're not that interested in turning down the volume on home transactions, because if they did, they'd have a huge budget hole.
Well, and that's the thing. That takes us to the next slide. But because housing transaction volumes as a proportion of housing stock have basically, well, more than halved compared with their previous peaks back in the early 2000s, that's left the state governments in a really bad place. Because they could have housing prices fall by 40% tomorrow, but if housing transaction volumes rose back up to where they were in the early 2000s, they'd be better off than they are now. But those things do not happen quickly. You can't have something where you suddenly go from, a doubling in housing transactions and a 40% collapse in housing prices. Even though that is a scenario that could potentially occur over a long enough time horizon. But in the short term, their revenue would get poleaxed. So they have a vested interest in prices staying high because turnover is awful. And also, it's also worth noting that there was an interesting study into this by the New South Wales state government, and they found that once a household reaches a certain age, generally somewhere between 55 and 60, the chances of that household moving basically declines towards zero until they're eventually forced to move by circumstance or they pass away. So you're going to continue to see housing turnover suppressed by the demographic result of an aging population. So the states have another problem there.
Right, and I suppose the other point there is that the average home value has gone up quite a lot, which means, of course, that the stamp duty take has continued to rise, even as the volumes of transactions are falling. Although, of course, in New South Wales now, they've got this alternative for some people to opt not to make the stamp duty payment, but actually to defer it and pay over time, as it were. But that, of course, has had an interesting little impact where it's lifted home prices in some areas where a lot of people are doing it. So that's a zero-sum game in terms of actually solving the problem. And I guess the point I'd make also is that there are other taxes, development taxes, for example, so new land and all those sorts of things that the councils in particular also benefit from too. So there's a whole other flow of revenue relating to the construction and development of new homes. So much of the whole of the economy is supported by what happens with housing. So it's got itself into this incredible situation where it's wrapped around everything.
Yeah, and that I think is just really one of the sort of key elements of today's show. I mean, and even of, the sort of visual representation that was, somewhat jokingly included is the first slide. If you try and end this, there will be challenges, there will be pain. But the alternative is continuing this forever and basically imposing a greater costs on the have-nots to save generally and overall the haves. So I think that that's sort of, a conversation that we need to have as a society that we admittedly probably won't. But, that the current status quo has costs. And I think it's very silly that we just go, well, GDP number go up, employment number go up. But when you actually look at things like, so for example, real household disposable income or real wages or any number of other, meaningful indicators of what it's really like at the coalface, things are, quite a bit more challenging and real on a lot of those indicators, they're where they were 15 years ago. So, there's not really much progress there at all to sort of crow about.
Right, and talk about the Paperchase again. The GDP Paperchase, top line GDP is the only thing that anybody focuses on because that's just activity, and so the more activity, we're doing well, but of course the GDP per capita continues to degrade as we bring more people in, and as effectively the earnings of the country are diluted. And I'd also make the point with GDP, of course, it measures weird things as well that you probably shouldn't want to measure in terms of positive outcomes. The other point in all of this is it's worth just thinking about the banks, right? The banks have built more and more of their business from home lending. So we have banks with the highest proportion of home mortgages in their book relative to almost any other banks around the world. And if they actually started to see the value of property go down, there'd be a financial stability risk too. So as well as all of these economic things we've been spoken about, there's the financial stability risks that would actually be likely to emerge if property prices started to fall, which is another reason why the RBA and APRA will probably do things to try and stop property prices sliding.
Yeah, the question is how much scope they're going to be provided, and that's going to be an interesting one in the next, year or two, I would say.
You mean it could be inflationary?
Well, there is certainly the inflationary factor side of things, but there's just also the fact that, the possibility of them just throwing caution to the wind and doing rather silly things to save the property market. And, let's be honest, that sort of thing is possible.
They have form. They have form.
They do have form. I mean, and I think that we've really seen from Albo even the lengths and the suffering that they are willing to impose on people.
Yep.
To secure that particular goal. Now, whether or not that's been done deliberately in pursuit of that goal singularly, I don't know. I can only speculate, but it has had the effect of propping up the housing market here in Australia, in Canada, in New Zealand. And, what have they all got in common?
Yeah, spot the common theme.
Yeah, exactly. Okay, now, this is an interesting one from... I have the wrong chart. That is awesome. Anyway, this is meant to be a chart of the proportion of borrowers who have expenses greater than their incomes based on the HEM. Now, Martin and I discussed this last week. The HEM is, shall we say flawed. It assumes that a very, very basic standard of living, and it assumes discretionary expenditure in the 25th percentile, which means lower than 75% of households. Now, Chris Joy did an interesting analysis on this on Twitter and also on Livewire Markets, where he found that 25 to 50% of higher loan-to-income borrowers and 15 to 32% of high LVR borrowers are estimated to have an income level not sufficient to meet their housing costs and their necessary expenses. Now, the RBA in their analysis defined high LVR as an LVR of over 80%, but they defined a high loan-to-income ratio as a loan exceeding 4 times household income. Now, I think we both know, Martin, that is not a rare thing in modern Australia. There are a lot of loans being written out there at 4 times household income, 5 times, six times, and a whole lot more in the past.
You're absolutely right. Yeah. So the data that I've got shows that there were loans written at 6, 7, 8 times income, particularly a little while ago, but they're still in some cases going to that. And the HEM is just such a narrow measure relative to what people are actually spending. And of course, I run my mortgage stress analysis, and I look at the total spending pool that households have. And we've now got more than half of mortgage holders underwater from a spending pool perspective. Now, that means that they're actually spending more than the HEM. Because if the HEM was actually defining accurately what people were spending, then there would be no problem for a lot more households. So we've got this big gap. And it's also worth making the point that a lot of the data that the RBA is using is actually to do with the Hilda data, which is 3 years old, or the securitization pool data, which of course are mortgages that are sort of handpicked to actually be the more valuable ones in terms of going into the securitization pools. So the sampling that they use for their analysis, I think, is also potentially flawed.
Well, I think that that sort of just illustrates that we're in a position now where the key factor is time.
Yep.
Rates are high enough to cause some serious problems, and that's a point that Chris Joy's made, himself. And I think, and I agree with him. I think that right now the key component is time. The longer rates stay high, the more challenging it's going to be for mortgage holders, the more challenging it's going to become for the economy. and the harder it becomes for the RBA to continue to guide the economy down this the so-called narrow path. So, yeah, I think it's going to be challenging.
And it's worth just underscoring, of course, the higher for longer narrative is getting stronger and stronger. And in fact, the markets were originally assuming there'd be rate cuts this year, and then they were assuming there'd be rate cuts in the early half of next year. And now the markets are suggesting, well, maybe there won't be much at all through next year, so it's 2025. And in fact, the RBA was recently suggesting that inflation would still be above target through the whole of next year. So the chances of interest rates coming down much at all in the short term is close to zero. The other point there is, if in fact we've got this structural change, as we were discussing with bonds earlier on, it may well be that we will never see the rates coming back down to where they were just 18 months ago, which means that we're actually locked into a higher for longer environment into the future, which means that many households have got nowhere to run.
Well, that's the interesting thing for me, because we've had basically what I would consider to be two super cycles in rates. One started in 1968, and basically you saw mortgage rates in Australia trend up and up and up and up and up, all the way until it got to, the highs of the near mythical 17.5% in 1990. So that was a 22-year cycle. Then we had another, what I would consider to be a super cycle, from the latter half of 1990 until just before they started raising rates last year. And that saw rates go from, the cash rate go from 17.5% down to 0.1%. So I think there's just, the question is are we at a similar turning point as we were in 68 and as we were in 1990, just depending on which direction it goes in? It's going to be interesting one way or another.
Yeah, and the markets until recently have been betting on significant cuts in rates relatively soon. And that's true here, that's true in the US. One of the reasons why the equity markets were still very buoyant. But I think there are some doubts now beginning to come in terms of actually suggesting what may or may not be happening. And again, I go back to what Powell said just yesterday, that the expectation has to be that rates will be higher for a lot longer. Interestingly, of course, some of the Feds also said, well, we'll let the bond market do some of our heavy lifting for us, right? Because, of course, bond rates, as we said earlier on, are a lot higher. But there was no indication of rates falling. It was just they were going to be higher for longer, but maybe not having to go up again. So there's a real interesting conundrum here. And if in fact we are now in an environment where interest rates are going to stay a lot higher for a lot longer, the mortgage noose is going to get tighter and tighter, because as you say and as Chris said, it's time. And I see that in my stress analysis. You can muddle through for a few months if you've got a cash flow deficit. You can put stuff on credit cards, you can cut back, etc. But at some point there's a determination point that says, hang on, something's got to break. And I know we're going to look at some data in a second that shows that actually it takes a long time for this to work through and potentially lead to things like defaults.
This is from Housing Australia, and I think that this shows something really, really important. For someone using the first home buyer guarantee in an urban area, their the median household income for someone taking part in this program is $124,000. Now, based on median household income nationally, that's about 20% above, thereabouts, depending on what sort of estimations you want to use as to how much that's grown since the 2021 census, which was about 2 years ago. But I think it's just worth reflecting for a moment that a household income for a couple, a household income that was 20% above the median, if you go back in time, let's go back in time to 1996 to Sydney, that's enough for that couple to comfortably buy a 3-bedroom house on their own, with no support, no nothing, just doing it on their own. And I think that just goes to show just how much things have degraded and how much things have changed from the days of, oh, well, I did it on my own. Well, yeah, you did. but this is the cohort now needing help to get into the market, because it is so hard to save that deposit, and things have changed so dramatically from when you could save a deposit in 3 or 4 years, back in the 1980s or in the 1990s.
Yeah, I won't cue the Benny Hill music, but no, this is a joke. I mean, this is showing you just how broken the housing market is. And the fact that and in fact, the Productivity Commission made a similar comment quite recently, suggesting the first home buyer support mechanisms that have been put in place are not actually supporting the people who need it. What they're doing is facilitating those above that to get into the market, but they probably would have got into the market anyway. But there's another total cohort that just cannot access it because they don't fit the parameters. And I think that's exactly right. And, the first home buyer levers don't actually help the people who need the real help just to find housing, whether it's social housing or whatever. So all of these programs are actually targeted at a sector of the society that are not the least affluent. They're sort of in the middle ground.
Well, the truly crazy thing to me is that you can qualify for the first home buyer guarantee on an income of up to on a combined income of up to $200,000.
Yep.
Now, is it not kind of crazy for the government stepping in and getting on the hook and using taxpayer resources to help a couple that earns more than double the median household income? That just doesn't really compute to me.
It goes back to who are they trying to help and, what are they trying to do with it? I go back to my announceables theory. Sounds good. We're helping people get into the housing market. 30,000 people or whatever it is got in last year. Aren't we good? The question is,
they've been doing it since 1964.
Exactly right. Announceables, but it doesn't solve the fundamental structural issue that we've got. Right. All it does is it allows a little bit of flux around some people, the more able people to get into the market, but it doesn't solve the fundamental structural issue we have, and that's the problem. And I'm going to have underline small rant coming. Right. The voice over the last 9 months was complete misdirection, right? All of that focus on something which I know it's important, but this issue of housing and the structural issues that we've got and the crushing of households should have been the big conversation, should have been the focus of trying to solve some of these structural issues. But no, we've got tactical issues around the edge that are actually not solving anything. And we had a massive misdirection over the last 9 months plus. And in the meantime, we've ended up creating a bigger and bigger monster. Rant over.
Yeah, I must admit it was somewhat grating reading the Mission Australia report into homelessness recently, and then pointing out how the rate of Indigenous homelessness was rising, yet that wasn't getting the airtime it deserves, even in the context of having a national discussion about Indigenous issues.
Yep.
And if you want to talk about homelessness more broadly, even in like the first, a recent report that I think was into the first 4 months of the year showed that, 1,600 people were becoming homeless every month. And I have a feeling that's probably underestimating things to, a fairly sizable degree.
Yep.
Yet are we discussing this, these thousands and thousands of Australians becoming homeless? It's not making it to the government's agenda in the way that I think it should.
No, and you can talk about tent cities, you can talk about people living in cars and couch serving, and we're talking about thousands and thousands of Australians who have no housing solution that makes any sense at all, and yet it's not being talked about. And I don't understand why, even in the mainstream, it's not being focused on. They're talking about property prices going up and mortgage rates. Well, what will happen to mortgage rates, right? But there's a much bigger agenda that needs to be discussed about housing. I think housing is a human right rather than a market-driven thing. Now, maybe I'm unpopular there, but that's my view.
Look, I think that housing as a basic necessity, yes, I concur with you. I think it is a human right. I mean, I also understand that on the other side of the coin that there is the private investor side of things, and that does have a role to play to a degree. And I think the thing for me personally is that we had it right decades ago, or we had it a lot more right than we have it now.
Yeah.
We had, 50% fewer property investors proportionally. We had a much, much greater, social housing program. You had the government, you literally had the Liberal Party and the Labor Party get into debates and fights over who could build more social housing during their terms in office, because it was good for the country, because it kept people employed, because it powered the construction sector through cyclical downturns, and because it got more people into affordable housing and put downward pressure on the cost of housing because there was a government alternative. This is something that Cameron Murray, who you had on earlier in the week, has covered quite extensively and quite well, I might add. And, I think the thing is that there are answers. Now, I know that politically that there are challenges. And I know that when you are confronting a challenge, or you're confronting a situation where something's different or where something's new, that's really, really hard, because there is no precedent. There is no guidebook. There is no, well-trodden path to follow. But I think the thing that sort of annoys me the most about this situation is we have a playbook that worked for decades and decades and decades, that managed to, drive Australia's home ownership rate up to, its highest level in history. Yet we just go, no, we're going to do something different. We're going to keep doing the same thing we've been doing for the last decade. We're going to spend, $7 billion on foregone revenue from negative gearing, but we're not going to fix bulk billing because reasons.
Absolutely. It's about priorities, isn't it? It's about priorities, and I suppose it's also about philosophy, in terms of the neoliberal philosophy that says let the markets be the markets and don't interfere, and let the private sector do all the heavy lifting, etc., etc. And it's failed. I mean, the bottom line, if you look over the last 2 decades, we've got less people who own out their property outright. We've got bigger housing problems. We've got much more of income going to just get somewhere to live. And by the way, just worth thinking about, if in fact households had more income available to do other things, that could create significant economic momentum in the economy, and maybe we'd actually get more investment in businesses and other things going on in the economy. But effectively, this housing monster is sucking all of the oxygen out of the room. It's just making people focus more and more and more trying to get into the property sector at any cost. And I think Australia's a worse place because of it.
Unequivocally. I mean, I wish I could disagree with you, but I can't. That's just, it's basically an undeniable fact. I mean, you look at something, like any measure of, household income, of consumer spending across the various different demographics. It's not a pretty picture, and it just goes. And once you start getting into a granular breakdown of those things, it becomes clear who are the winners and who are the losers. And while there are obviously variations within every, age and wealth demographic, the general winners are older generations and the general losers are the younger generations. Now, I will repeat again, that is very much a generalization, and it's an aggregate figure. So your mileage probably will vary.
Absolutely. Did you see, though, a couple of weeks ago, there was the latest report about some politicians owning investment properties, and so that list was published. It's publicly available, and it's interesting that both sides of politics, many pollies, have multiple investment properties. So once again, one wonders whether, to an extent, they're also on both sides of the fence when it comes to this question of trying to tackle property.
I do think it's interesting that if you own a farm and you get some government subsidies, that's apparently a huge, this big no-no. There's been huge issues with it in the past, but yeah, if you own a couple of investment properties and stuff, it's just a Friday.
A couple, many have 4, 5, 6. I noticed. So,
I was being generous. Yeah.
Now let's get on to the next slide, because there's a really, really interesting thing to talk about here.
Yeah, well, this is what we were talking about, wasn't
Yeah.
it?
Yeah.
This is Australian real household disposable income as deflated by the CPI, which is basically just means I've adjusted this for inflation.
Yeah.
And I started this snapshot in June of 1998, and basically people are, worse, are basically today are where they were in 2010.
Yeah. And that's the killer slide, right? When it comes to actually understanding why it is that people have so much difficulty, right? The fact is that we start with less real disposable income and then overlay that earlier discussion about, and we're putting more of it into the mortgage or the rent, and you can understand why households have so much pressure.
Yeah, exactly. I mean, it's a double whammy, isn't it? If you don't have the income growth, you're not going to be able to consume, and that's why you see all these various charts of various demographics not being not having any real growth in some cases since 2005, 2006.
Yeah.
So it's just this, and then I think the thing as well is like people turn around and go, well, why aren't young people spending? Like the latest CBA data shows declining levels of nominal spending for people under the age of 35. And it's like, well, you want us to save for a house? That's what we're doing. That's what we're doing. We're doing what society has told us to do. It's going to kick society and the economy in the nuts eventually, but we're doing what we were told.
Absolutely right. And that's the problem. So now people know that the game they've got to play is this game where they've got to try and get into the property ladder. The property ladder, as I said, drawbridge is going up. It's getting harder and harder and harder. More people will fail to ever own a property. And yet it's still there, sort of right at the center of people's focus and aspirations and around the barbecues and things. But it's a mess. It's a real mess.
I find it ironic, right, that we subsidize, that there's tax concessions and everything on offer for property, for negative gearing, for investing and stuff. Yet the fact that fewer and fewer people are going to own their own homes and fewer people are going to be secure in their retirements as a result of that is also going to end up costing the government money in the long run. So, in that particular vein, we all lose.
That's right. And of course, all the research shows that if you actually are a renter through your life, when it comes to retirement, you still have to pay the rent, right? So you don't have somewhere that you can actually live when your income's going down. So you're going to be much more reliant on the pension and everything else. So I think the intergenerational issues here and the long-term structural issues are the things that need to be discussed. And again, go back to my point. Look over there. We'll give you a few more dollars to be able to get a few more first-time buyers into the market. We fix the problem, or we will build another 1.x million homes over the next 5 years. We'll never be able to do that, but that's what we're going to say we're going to do. None of this is tackling those fundamental structural issues we're talking about today.
No, and I mean, even if we look back longer, a fair ways, something like 20% of people, once they reach the age of 65, never owned a home. Even there's basically, as far back as you go, they never owned a home.
Mm.
And that number is going to rise. The number, as you mentioned previously, the number of people who own homes outright has fallen significantly over the years. So you've got people who are going to be retiring with debt, and you're going to have people who are going to retire after a lifetime of renting, and that's not going to be good for the government. The government coffers. But I mean, we've got to have our superannuation tax concessions and everything like that. To the nth degree. I mean, to be completely honest with you, I don't know why they didn't just put a reasonable number in stone back when they introduced super and just said, okay, this is what it takes to retire. It's a multiple of the median household income of what it takes to generate it. Enough income with a bit of drawdown. That's what you get. The tax concessions on. That's what you get tax free. But instead, there's people out there with $500 million in some of these super accounts.
Absolutely right, and they'll be marginally taxed a bit more, but it's still very marginal. So let's get on the next slide, I guess.
Yep. Okay, now this is going to be part of just sort of little sequence of slides I'm going to do just now. This is of the proportion of the proportion of new American mortgages that are written with adjustable rates. Now, as you can see, when you go all the way back to the early 1990s, the proportion was basically near non-existent. It was basically just a very challenging thing that you could take on if you had not fantastic credit. But as prices rose and as things became more challenging, in particular, you see that the peak there, just in the run-up to the global financial crisis, a lot of people took on these adjustable rate mortgages. Now, what a lot of these mortgages had was a 1 year, 2 year, or 3 year fixed period under which they had a teaser rate, which was generally a rate that was below market, or at the very least below what someone in that financial position with that credit score could hope to achieve. Then it would rise to a higher variable rate, and they would basically be trapped. And that's something that I think The Big Short and a number of other various academic reports have gone into quite nicely. But I think one of the things that's interesting about this is, even with all this sort of silliness that you saw in the US during this time, over a third of mortgages being adjustable rate in a country that's really not geared for it. And then on the other hand, you had the ninja loans, which is no income, no job, no assets, no problem. We'll give you a mortgage. Yet, despite that, if you look at I started this chart from when the Fed started raising rates in 2004. And if you then fast forward it to 2 years there to the middle of 2006, during that time, despite all the stupidity, despite the ninja loans, despite the fact that people had these ticking time bomb mortgages, mortgage arrears had risen by only 0.02% across that time. So this is why I think and this is why I think Martin mentioned earlier, why time is such a key factor, because no matter how stupid something is, it takes time for these things to play out, even with, idiocy that arguably significantly exceeds our own mortgage cliff and our own TFF created challenges here in Australia.
Yeah, and just to re-emphasise that, people have been saying, well, stress is high on your measures, Mr. North, but why aren't we seeing high delinquencies? To which I reply, just wait. Wait for the next 12, 18 months, 36 months. It takes time. And, that chart really just makes the point. It takes a long time for this to work through, not least, of course, because people can, get by for a bit. But eventually they run out of runway. And if interest rates are going to stay high for long, that's going to be the problem.
Yeah, exactly. I think that's something that's just underappreciated in all of this. It's so I hear so much, the mortgage cliff was a furphy. It's a nothing. It's like the mortgage cliff only just entered the peak of the expiry of those loans 3 months ago. 3 months ago, back in July. Now, you'd have to be pretty silly to get into trouble so incredibly quickly, especially when in some cases it's as easy as picking up the phone to the bank and saying, well, I'm having a rough time.
Yep.
I'm having a rough time. Can you guys cut me some slack and help me out a bit? And in some cases, that's enough to keep the bank to keep the wolves away from the door for 3 months, 6 months. In some cases, I'm hearing as long as 12 months. So, it's a much, much more complex thing than, it's more of a sort of downward trend rather than the cliff motif.
Well, and of course the banks are motivated to extend the pretender for as long as they can because they don't want to actually disclose higher levels of delinquency, and so they will go through those programs, which includes restructuring of loans over time, pulling out equity to allow people to pay the mortgage over the next 12 to 18 months out of that equity. So I'm seeing that quite often. So there are things going on at the moment below the waterline to try and keep the delinquency pressure cooker down. But if you look carefully at some of the early data now, you're starting to see the first signs of delinquencies beginning to rise and then moving more quickly than previous years. So I think it will come through. And then go back to my other point, of course, rates are higher for longer. They will stay high. Real incomes are not growing, as we discussed earlier on. So where do people go? I mean, at some point, there's got to be, okay, we can't keep this going. But on the other hand, if you have no other place to go, and you can't get into the rental market, you're going to do almost anything you can to try and keep that property going. So what are the other consequences in terms of, not spending on healthcare or not spending on other things just to try and keep feeding the beast?
Well, that's something that, you and I have discussed previously, just in the sense that, something that, that we've discussed, I think it was probably about, 2 or 3 months ago now, but was the end of the rental crisis is going to take significant pressure off the broader property market, because you're not going to see, as you say, all these people desperate to either get in or desperate to stay in if the rental crisis was to abate and things were to sort of, begin to normalize. But with the latest, data pointing, to a reacceleration in the size, in the size of the labor force, into the you got Deutsche predicting over 500,000, a level of 500,000 net overseas, for net overseas migration.
Yep.
That's not going to happen. So, that has really, really changed the calculus. I mean, we've very much gone from, this is just a catch up, or this is just the returning students or whatever, to something very, very different. So, that then takes us from a place of, okay, well, we know roughly how many students there were, and ergo we have an idea of when this will begin to abate and when it will begin to end, or perhaps even reverse. But if you were to ask someone, even some of the best analysts in the world who cover Australia, when do you think migration is going to return to pre-COVID levels, as all the various forecasts, the intergenerational report, the budget, all these other different things say it will, they tell you, I don't know. Even some of the best analysts have already been wrong-footed by just how much the net overseas migration rate has rocketed and continues to stay high.
Absolutely. Well, structurally speaking, unless we pull some of those levers differently, we're going to actually just perpetuate the same old. So more people will be excluded from property, more people will be struggling to try and actually make those rent payments or mortgage payments. And of course, there's other people who are doing very well from this structural distortion that we've got. But I still don't know whether we've got the appetite as a country and as a political class to actually deal with the fundamental issues. All the history says no.
Well, you have people now starting to talk about immigration being, the next big issue that will be, that potentially even the next election will be fought over. So there's that side of things, but I think there's also the side of things of, if the economy does go south, historically migration has dropped. Now, I'm not sure how much of that is driven by basically the government using their brain and thinking, hey, it's not very intelligent bringing in so many migrants into a nation where, they're basically adding to the jobless queue. Or how much of that is just, sort of mere pragmatism of existing migrants and temporary visa holders going home because basically the job prospects are not very good. So I think that's going to be one of the really key questions going forward, because you've even got you've got Deutsche, you've got AMP and others talking about a recession here in Australia being a coin flip. Well, if the coin comes up on the wrong side, what happens then? What happens to the demand for housing? What happens to rents? These are all very, very good questions that I don't really think we have the answers for.
No, absolutely right. And I think our tour through the housing disaster landscape really it puts it all together, and I guess it highlights the fact that there are some big and important decisions which should be taken. And I suppose it's also worth making the point, it's not just us, right? So New Zealand and other places have the same issues too.
Yeah, they do. And I think I shared a few shows ago of housing prices in Sydney, Auckland and Toronto, and then graphing them as the migration soared to record levels, and the secret ingredient of keeping housing prices high even with rates rising is a rental crisis and making people's lives miserable. And that particular model has been adopted across across much of the Anglosphere, unfortunately, which I think is really sad, because I don't see this ending especially positively. Because I have, very much gone out of my way to point out the different stages of the rental crisis, the origins of it, and the fact that a lot of it occurred before the borders even reopened. But I think the sad thing is that, what too often ends up happening with this sort of thing, even here in Australia, is the wrong people get the wrong end of the stick. The individual migrant gets the wrong end of the stick, and I don't think that's fair. It's not the individual migrant who's pulling the lever of, X number of migrants that, that perhaps is too much for a given area to be able to cope with. So I think that if there is to be criticism levied, it should be levied at the government and not the individual people who just want to come to Australia for a better life. Because, I can totally relate to that. I mean, I can imagine that if I lived elsewhere, perhaps I'd want to come to Australia for a better life.
Absolutely. And the final point there is, of course, you did some modelling to show that if the migration rate continues, then the unemployment rate will go up.
Yeah, unfortunately, yeah. If we see jobs growth continue to decelerate, and we also see if we see jobs growth decelerate to roughly where it was pre-COVID, on the pre-COVID 5-year average, which is a fairly sort of robust 22,000 jobs per month. Which is, if you put that into US terms, that's well over 240,000 jobs a month in the US, if that's your preferred measure, which is still a fairly solid number. Especially because it's not coming from a point of, recovery from a recession or anything like that. It's just purely, pedestrian everyday level growth. And that just assumes that the labour force continues to grow at the rate that it's been growing in recent months. And yeah, it's not a pretty picture. You're talking about, potentially 5% unemployment sometime next year. So I think that that's something that really just needs to be, kept in mind going forward. I mean, if not for the decline in the participation rate that we've seen recently, unemployment would already be higher than it is now.
Absolutely. And I think it's just worth, as we come to the end of the show here, Tarric, this is going to be a really long one, that, the data doesn't lie. Once you actually step through this logic and actually see how the arguments work, the data doesn't lie, but it's not the data that a lot of the mainstream want to talk about, and that's a problem.
I think, to be honest, I think the immigration issue has got a fairly decent shake in elements of the media recently. I mean, the thing is, I managed to get, sort of plenty of stuff, published with that. So does Leith from Macro Business. He's got quite. He was even on 2GB. I was either yesterday or today talking about the issue, and I think that there is sort of an appetite to discuss it. But I think that the problem is that when that sort of starts to get translated into the political sphere, it just becomes kryptonite.
Yeah.
And there are very few people who really want to touch that and to potentially, shall we say, touch the third rail of Australian politics.
Well, I would say that we've been holding on to that third rail for quite a lot of this show. Which is maybe feeling uncomfortable for some people, but it's a really important conversation to have. So thank you very much, as always, for the charts and all the work. And we've put all links and things below. And I guess we'll pick up the conversation in a couple of weeks' time. And of course, there'll be more new stuff to explore.
Yeah, we said, we live in interesting times, and they just keep getting more and more interesting.
They certainly do. And unfortunately for ordinary Australians, the consequences are, potentially relatively devastating. So hang on in there, guys. And, I guess the other point to make, if you have a set of financial pressures, it is worth trying to understand your cash flow, talk to your bank, all those sorts of things. There are things that individuals can do, because you certainly can't rely on the government to sort it out.
Yeah, I agree. If that's something that you can jump on and that you can address early, before you start finding yourself in real trouble, that's definitely something that's worth exploring, and getting the right advice from people who are in the know.
Absolutely. Tarric, thank you very much once again. And I'll look forward to picking up the conversation in a couple of weeks.
Yeah, me too, mate. Looking forward to it.
Take care. Cheers.
You too, mate. Bye.